What kind of stablecoins trend do you see in the future? What to expect from them, and what are your plans for the development of this sector? Looking at the numbers, this is a huge market and it still has room to grow. What do you think about the cost of Bitcoin and Ethereum?
As a result, this situation was resolved by the USA government. They said that they would save the situation.
How did you attract 650 million?
There were rumors that the bank wasn't able to pay off its obligations. Clients were trying to withdraw money, and it ended up with a bank run.
Hey guys, hello everyone. Welcome to the Alt3 Insight podcast. Despite the fact that the market has been falling recently, there are products that keep their cost, are not exposed to volatility, and are going to increase their capital. We'll talk about this today. Our guest today is Fedor Chmilev, co-founder of the Resolv project. This is a kind of hedge fund acting as a DeFi crypto project and presenting own stablecoin. He attracted $650 million to his project in 2 months. Fedor, welcome.
It's a pleasure. Thank you for invitation.
Thanks for your time.
Thank you for mentioning some details about the project. We'll probably discuss it further. There's a lot to add, maybe correct, expand the topic, but that's what we're here for.
Let's move on to the idea of the project. What's the idea of your project and how does it work now?
I guess it's right to say and present not just as some kind of tokenized hedge fund, although basically it describes a significant part of what we do. In our strategy, our goal is to allow different categories of users who either don't want to delve into it themselves, who don't want to manage their assets very actively for a very long time. Our goal is to allow them to use crypto net fields so that they just don't have to spend time on it. So yeah, that's the idea of the project. That's what the project is about.
Crypto profitability, right?
Yeah, crypto profitability. What's our feature? We take one of the types of trading strategies, which is called a delta neutral strategy. That is, if we simplify it super highly, we hedge the risks of price changes. And one of the implementations is to take part of the position with a long and part of the position with a short. Whatever the price of the basic asset goes, one will level the other. In theory, it sounds great, but in practice, you just hold these positions, perform some operations, you'll usually pay some commissions to trading venues, or if this is even an on-chain platform, you'll simply pay for transactions. And you'll have some kind of annual minus. But in practice, you can make money on this, depending on the base asset. In theory, this can be any other asset with a certain market value. But you can also earn with low-risk profitability, for example, by staking, as we do with Ethereum as the main asset.
Let's explain to Web2 investors here. So you just buy Ethereum, put it into staking, and additionally, short this Ethereum, and earn financing rates.
Yeah, that's right. Again, to people who are out of the topic, it can be explained that many classes of assets work in the same way as well, not only crypto. But again, it depends on the goal, whether you want to save or earn, and so on. In theory, you can probably do it even with fiat. Again, you can just put the long part into Treasurys, what is now considered a relatively low-risk action. Well, the shorts also have their derivatives that can be used.
As a fact, over the past 24 years, the volume of stablecoin transactions has amounted to more than $15.5 trillion. This is more than Visa and MasterCard combined. This is the first fact. At the moment, the volume of stablecoin offers is estimated at $240 billion. This is about 1% of the entire USA M2 cash flow. $250 billion is the valuation of the token offering, which includes, of course, the capitalization of the issuing companies that issue these tokens. And you compete with large companies that issue these tokens as well. What kind of stablecoins trend do you see in the future? What to expect from them, and what are your plans for the development of this sector?
You probably expressed the indirect idea that stablecoins as a concept and as a set of products are a so-called market fit product for crypto. Probably one of the main ones, if it's not the main one.
I guess the main one is tokenization.
Yeah, tokenization of assets. Not in the form of stablecoins only, but in the context of stablecoins. This is objectively, and if we rely on the numbers and what you mentioned, this is a huge market, and it still has room to grow. My personal opinion, which is close to my team's point, is that the crypto market is still quite young, and there's still a lot of room for growth in terms of adoption, where and how it can be used. And I want to say that people know less about that compared to fiat currency. For example, instead of a credit card, I will use a stablecoin. But you can use stables and fiat not only for direct calculations, but also as a fundamental asset for other operations, strategies, derivatives, etc. And what I'm saying is that stablecoins have room to growth. Their variants, how it can be used, and so on. And also the big area here is regulation, which probably, especially in recent years, is clearly beginning to thaw out. It's becoming more specific, but it's still not enough. Let's say not good enough to make people, first of all, trust it. Many people look at crypto as either some kind of complex tool, or there are many rumors that we are scammers, that we hacked someone. This is the story that will develop in a positive sense. And many people, even talented founders or talented people from finance who know how money works, how to use it, they just don't want to risk or get into some poorly regulated things. I mean, the regulation will get better. And accordingly, users and entrepreneurs who will develop it will also improve. They're going to improve qualitatively and quantitatively. Speaking of regulation, how can a new bill on regulation of stablecoins in the United States affect you? As far as I know, they're obliged to keep the provision in the form of American bonds. How can this affect us? It's affecting us now. We do not officially work with American clients. Mostly for this reason, American laws and their attitude just should be as clear as possible. They should be as transparent as possible. It should be clear how Americans relate to these laws and comply with them, because a significant part of the world is also following American example in terms of the development of its laws and regulations. How do you think it will affect you? Negatively? Or will you somehow fit in here? Well, we'll definitely fit in somehow. Again, we do not expect that this regulation is set in stone. As I said, we expect that it will develop, and from the side of America as well. Friends, in the flow of meetings with market leaders and experts, we do not always have time to tell you our news. In the next 30 seconds, I'll explain how it can be useful to you if investment is not a game for you, but a conscious path. At Alt3 Capital, we have assembled one of the most powerful analytical teams. I'm proud of how we analyze complex processes, connect points, and form investment ideas. These ideas, born in the inner workings, allow our investors and partners to find opportunities that remain unnoticed. We decided to reveal a part of this process and invite you to Alt3 Insights. This is a space where you can observe the real work of professionals, understand their logic of thought, understand the causes and consequences that stand behind measured, effective investment decisions. If you value deep analysis but not superficial guesses, if you're close to a systematic approach and far from chaotic movements, if you want to understand the essence of the processes in the market and not blindly follow the trends, we invite you to our armory of thoughts. Alt3 Insights is a place where thoughts turn into capital. Just leave an application using the link in the description below and take the first step towards the professional community. The problem of centralization of stablecoins. USDT, or rather its issuer Tether, imposes the ability to block tokens on the wallet. And for example, let's take the last case when it blocked almost 23 million USDT on the Garantex wallet due to the sanctions. Do you have such a function? How do you look at this? What do you think about this event? Is it right after all? I look at it this way, without any emotional or personal judgments, whether the laws and regulations are correct or not. If they're specific enough, we'll do everything to comply with the law. The main thing is to make it clear. If we're talking about your example, of course we shouldn't block someone randomly because, for example, we don't like their face. In the perfect world, but we both understand that the world is not always perfect, and I'd like to have criteria when to block someone, and I'd like to have criteria when to unblock people. The process is now very actively developing, but hasn't yet come to a good, let's say, clear format. And this is exactly what prevents many people from using such products.
Well, do you have such a function now? Well, in general, if of course you don't want to be blocked, it's probably better not to misbehave.
Well, by the way, we didn't get into one important aspect, but it's worth mentioning. It's important in the perspective of potential regulation, security, and some other aspects. Well, because of our desires and relation to the situation, and the fact that we are not a decentralized, permissionless project in every sense, so to speak, we work with centralized exchanges and so on. It's important for us to be sure that it's not terrorist money, it's not stolen or something like that. So we check our clients, scan their wallets and so on. But if there's even a slight suspicion, we block them and we do not accept it.
I agree, that's the right approach.
To be honest, just in case, this is my personal opinion, there should be no other thoughts. If you think about why not accept a few million dirty dollars, then you're not going in the right direction. There's no doubt about that, that's for sure.
What do you think about the cost of Bitcoin and Ethereum? What prospects do you see for them?
Well, taking into account my current activities and relying on my professional experience, I think that both of these assets are volatile enough to save up a full-scale wealth in them. We can also put it this way, that they're not that stable and predictable, and if you can't afford to take a significant risk, then you don't need to invest a significant part of your portfolio or your wealth there. At the same time, Ethereum and Bitcoin are already stable enough to invest a significant part of your capital in them. But again, I'm talking from the point of view of an investor who actually holds something.
Do you have a portfolio? And what goals do you expect from Bitcoin and Ethereum, if there are any?
Yeah, I have a portfolio. If we talk about a wider portfolio, not only about crypto, but a significant part of it is in crypto. I don't have a single Bitcoin. I have quite a significant part of Ethereum and some ecosystem tokens. And in particular, I also hold our products as well. Probably this can be described as 90% of my crypto part of the portfolio. There's a small part of it that I just experiment with, but this is rather, I don't know, to test something, to understand the economy and mechanics of some tokens. I would probably not consider it purely as a part of an investment strategy, but rather an experimental part.
What goals do you expect?
In terms of portfolio?
Yeah, in terms of the cost of Ethereum.
I expect that it will grow in the long run. Again, if we're discussing the price aspect only. But at the same time, Ethereum has a good utility, not only in terms of assets that you hold, which to some extent I also use. I just make a lot of transactions and pay gas fees with Ethereum, despite the fact that Ethereum is one of the most expensive in terms of transaction costs, and the network at the same time is one of the most popular. Fortunately, it's not that expensive that you have to spend a lot of money for it. Well, maybe I don't do many transactions, but still.
Do you allocate your capital to your project and your strategy?
Yeah, absolutely. I believe in what we do. Even if for some reason, in the long term, the project deviates from the planned path or something, or some other kind of change occurs, I will definitely allocate a significant part of the capital in such a strategy. That's for sure.
What is your final profit, and what is the business model of the company?
That's an interesting question, and the answer to both of these questions is quite interesting. Firstly, about the final product. Originally, we all started, our team and specifically some of the founders and the core team, they're the people who first of all will look at figures in Excel before doing something. Well, probably this is a necessary and good characteristic for the product we make,
so they could test it.
What we did, we took a simple graph of the historic returns of Ethereum. We looked at different assets, including such an obvious alternative as Bitcoin. We just looked at the historical data, at the model, at the distribution of conditional risks. First of all, funding rates, because they're probably the most volatile and sometimes can be negative, or maybe not, depending on the market and the period when you're trading.
What are the statistics for the last few years? For 2018, 19, 20, 21, 22, 23. What was the average annual funding rate for shorts and longs?
I'm not sure I can give you the exact figures and funding rates. In the whole strategy, when we had more accurate results on what we were doing and developing, we got something like 10-13%, maybe up to 14%, depending on the intervals and other parameters. And moving on to your next question, you asked about the monetization model and something like this. The main opportunity that we haven't used yet, but we will start to use it in the foreseeable future, is to just take some of this profitability. It's probably fair to say that we can take about 1% of that 10-14% that I mentioned.
At this moment,
we don't need it. In fact, I don't know, directly or indirectly, we invested in the product itself, in profitability for users mostly, but not only.
You give all your income to the users.
Currently, yeah.
What is your motivation to do this?
In the future, of course, we'll start making money on this. Now we're putting all the effort we can into growth of the product, even through some not so significant things like, I don't know, there's only 0.51% of the income difference. But for many people, this is also a noticeable income that can motivate them to use us.
How did you manage to achieve such a result? How did you attract 650 million?
The question is only about the money attracted from the clients. This is far from a one-day story. Probably the strength of our team and in general, historically, is that we invested quite a lot of effort in advance in terms of working with liquidity providers and with some other so-called crypto people, crypto investors, as well as our retail activity. We have been actively developing it for the last 6 months. Historically, and again, I don't know, maybe you can draw the chart of our TVL. We launched the product in a private beta at the end of May, I think, April. That is at the moment a little less than a year ago. We received the first about 15 million just through direct partnerships. And then it was summer. Again, if you look at the chart, it's almost flat.
And from December, there was
a bit earlier in October.
From November, December, there was an exponential growth.
There were probably several factors. Firstly, the crypto market was quite flat in the summer. There were no significant positive or negative events. Most of the world was waiting for crypto elections and other events, but we used this opportunity to invest effort and to develop relations with everyone nearby. Plus, several events started to happen in the beginning of the autumn. First, we started to open all this more publicly from the private alpha mode to the retail users. We launched the points program and started to actively add secondary markets. I think the first market was like where you as a user, omitting any whitelists and complicated procedures, will continue developing it so you can come and just exchange, for example, your other stables like USDC or USDT for one of our tools. Then during the summer, the same partners, liquidity providers, for example, many of them are just not super fast. And we frankly said that maybe they're interesting to us, but there's no liquidity. Also, many of them were on vacation, as they said. And in the beginning of autumn, they started to return from vacation. And slowly, the crypto network began to thaw. And they were saying something like, guys, what's up? Let's develop relations. And retail also began to actively, let's say, investigate our project from different sides. There were elections in the United States. The market realized which way the wind was blowing, what associated risks were worth paying attention to, and which were not so relevant. And this way, we gained the opportunity to capitalize to some extent on these market movements. And since October, we have grown from 30 million to more than 600 million, as you said. Something like this?
Let's get back to profitability. As far as I know, you have two products. How do you divide and manage it? As far as I know, 70% of the profit goes to the first product, first token, 30% of the profit goes to the second token.
Roughly speaking, yeah. The logic is a bit more complicated there. And before talking about the distribution of profitability, it's worth talking about the two products, how they're connected, and so on. Returning to the delta neutral strategy, tokenization, and so on, we had a fluff ball idea with which we started to iterate. It's probably also a separate question of how we came to it and why we're in this format. We can discuss it later. When a user chooses which of our products he wants to use, he has a choice of two assets. One that we position as a stablecoin, the other as a higher risk, more volatile asset. Depending on your risk profitability profile, you make the appropriate choice. Regardless of what you choose as a user, you bring money. We're talking about direct relationships, not secondary markets and so on within our strategy. We put them in one big pool, which we start to manage. Every day we fix the profitability, take the current supply of both tokens, multiply them by the prices, and look at the current valuation of the entire pool. Further, this difference can be either negative or positive. If it's positive, it means that we have earned, in the last day in particular. And most of the profitability is indicative of 70%. But the economy is a little more volatile, a little more dependent, and will most likely make it evolve. We distribute it to the holders of the staked version of stablecoin, to this less risky part. Indicatively, it highly depends on the period we take. It also floats there, as if from 4%, maybe even more than 10% of the annual profit. The rest we give to the holders of a higher risk asset, for example, 30%. What's the point here? The size of this low risk asset, the amount of money that is invested in it, is much smaller. At the moment, it's something like 100 million to 500 million. And we give these 30% to these users by changing the price to the appropriate difference. 1% of this asset, which is called RLP, so the profitability of RLP is significantly higher than that of USR token holders, which is obviously a stablecoin. That is, the proportion is roughly 100% divided into 6 parts. 5/6 is directed to the USR stablecoin according to the current proportions. 1/6 is directed to RLP. So if we calculate 70% of profitability for 5/6 and 30% for 1/6, it's obvious that the profitability per unit of assets will be noticeably higher. Again, it all depends on a bunch of parameters, but recently we've been getting twice as much, maybe even 2.5 times more profitability than for holding Bitcoin. What's the range of the numbers? From 10 to 30% depending on the period, depending on the market and so on. I checked the average for the whole period. It was about 10 for the first product and about 20 for the second one. Yeah, that's right. Again, it's super indicative. At the moment, there is a double difference, as we can see, returning to the fact that we track the profitability once a day. Once a day, We considered the first case when the profitability is positive for the whole strategy. Next, there can be some negative events. Why can it happen? The most popular ones are just negative funding rates, which in particular do not harm the liquidity of staking. And in the worst case, some conditional black swan event can happen. I don't know, again, a new FTX case might happen or something like that. Or it might be some other kind of crisis event. For now, let's consider a simpler case, when the funding rates are just negative. And there have been such cases more than once. They can be seen on the charts. Right when the market crashed, right? Yeah. Let's explain what funding is. This is a mechanism that balances the fair value on perpetual futures. And if the price, if more precisely, conditionally, to put it simply, if the number of those who take long prevails, they start paying the funding rate to those who are shorting. Or vice versa. If those who are shorting are prevailing, the shortists start paying to those who are taking longs. And accordingly, such a mechanism equalizes the balance and strives to align the futures asset value with the spot value. And then, in the period when the funding rate is not on your side and you are shorting, you begin to pay this financing rate. And this way you fix the loss. And if you have a loss, the second product of the insurance fund covers this loss of the first product. But the first product remains immune to volatility. Well, this is probably one of our key features, let's say our difference from other products. First of all, again, just to summarize, if there's a negative event, then the more risky asset draws all the risk on itself, leaving, let's say, the less risky asset, which we position as a stablecoin. So being a stablecoin is its key feature. And again, let's say here's how we came up with the idea about the stablecoin. The idea was born 2 years ago when the Silicon Valley Bank situation happened. So we can talk about it, but I don't know if it's worth talking about it now. We can talk about it briefly.
How did you come up with this idea? And I'd like to talk about the competitors as well. Athena, Usual, they have a similar design. Elixir also has a similar design.
Well, there are a bunch of competitors. The most common and often mentioned is Athena. And speaking about the fact that we have two tokens, on the one hand, this is a complication, and on the other hand, it's a rather significant difference. But let me tell you more about my path. At some point, I was working as an ordinary and sometimes not very ordinary engineer. And I worked in different companies, mainly commerce and fintech. One of the last things I did before my startup career, I don't know how to call it now, was cryptocurrency. At some point, I realized that I wanted to do something on my own, either as a startup or on the team at an early stage, so that my efforts will be more directly reflected in the results. I went through a few experiments, but at some point, I met two guys who, let's say, complimented me very much. Well, and I complimented them too. And I don't know, I'll just try to sum it up, but the guys really understand how money works, and I understand how to work with money. I mean, I know what things to pay attention to just to not to lose or reduce money of the clients.
As far as I know, you have 3 co-founders.
Yeah, I'm more into practicing part, roughly speaking, the engineering part of the game. How to implement all this, how to deal with money. The role of others are more, well, let's say it's divided into 2 parts. One of our CEOs, Vanya, is more active. He goes to everywhere. He has some talents for this.
Resources, network.
Yeah, resources, network, public presentations, relationships with investors, relationships with partners, etc. The second person was assigned as the CPO, Chief Product Officer. First of all, he thinks and cares about which components of this product should work, how to interact with each other, how to structure it so that the economy doesn't break down, we don't lose our money and clients, and so on. And I'm in charge of engineering, and I'm also working on a product. So, at some point we met, we were working on different products, also related to crypto, but it was far from what we're doing now. In any case, it was not very close. About 2 years ago, I don't remember exactly when the situation with Silicon Valley Bank happened. It's probably worth reminding this situation for those who don't remember or don't know, because some time has already passed. I don't know what happened to it, but it was a bank that was very friendly to startups and crypto companies. This led to the fact that some of these startups grew, they became rich companies, and accordingly, more money in this bank began to be stored. Crypto companies, the crypto market were growing, the bank was becoming quite large in terms of how much money it managed. And at some point, again, I won't get too deep into it because generally speaking, I don't know or I don't remember everything. There were rumors that the bank could not pay its obligations. Clients started withdrawing their money, and it led to the bankruptcy of the bank. That is when everyone is trying to withdraw their assets. The bank, even if it has them, may not have time to pay. Then the question of bankruptcy arose, and one of the companies that kept money in this bank, which is called Circle. This is a company that is the emitter of one of the most popular stablecoins, which is called USDC. And here's what happened on the market. The market thought that the bank had lost a part of the deposit for its asset. I don't remember the exact figures, 5-10% maybe. And the price of stablecoin on the market has dropped by 5-10%. The price of the stablecoin was 90 cents, maybe even lower. You need to check the charts.
Let me put it simply. That is, stablecoin USDC, due to the negative situation, there was an opinion that it might lose some of its capitalization of emitted stablecoins. And the price of this stablecoin was tied to the dollar and began to cost not 1, but 0.95. Yeah, roughly speaking.
Yeah, something like that. As a result, the situation was resolved in such a way that the US government stepped in and said that they would save the situation. I think they forced some other bank to buy it. One of the motivations to do this was because the clients began to look at other banks, neighboring banks, and also potentially withdraw money, which posed a significant threat for the entire banking system.
So, America saved the situation as always.
Well, not as always. There were crises before that, but apparently the government in particular is learning from its mistakes. It's great, of course. So, we were sitting with the guys discussing our project, and I don't remember exactly how it started, but let's say during a beer talk. That time we were talking remotely, we started just fantasizing on the topic of how to make our own stablecoin, which would not be vulnerable to such risks. So we came up with the alternative, which is not a fiat-based stablecoin, but a delta-neutral strategy. And in one of the first iterations, the idea was very close to what Athena is doing. I don't remember if Athena existed at that time. If it did, it was still a very small project. Did you see this idea somewhere, or did you come up with it yourself? I remember exactly that at some point there was an article, maybe by Arthur Hayes, but I don't quite remember exactly, to be honest, that definitely contributed to this whole thing. Maybe pushed it, but which one? I honestly don't remember. I can ask the founders, I guess. So we started to develop this idea, and we saw a potential problem here. We basically transferred the risk of a counterparty in the form of banks to the risk of, exchanges, for example, if we start shorting through them. Well, in general sense, it looks like one problem has been replaced by another, which can also lead to similar consequences. That's why we came up with the idea of a two-tranche model, a more flexible layer of insurance that can protect stablecoin holders. And the strategy of managing all this and balancing these assets is so that the size of this insurance layer always covers the size of the exposure, the money that we have on at least one of these exchanges. And again, one of the worst case scenarios that can happen to us is a FTX case. As I mentioned, that is, the exchange goes bankrupt. It goes bankrupt quickly. You cannot withdraw any money at all. And we want the holders to keep holding the stablecoin. At some point, we were inspired by this idea, so we started to look for the founders we knew. Just asking them for some feedback. We asked, guys, what do you think about it? And I remember that in the chats, they said that there was a similar project, Athena. Back in the day, not that many people knew about it. And it really added, let's say, some enthusiasm to us, as it was a kind of validation that it wasn't just us, let's say, who came up with something like this, but it also motivated us to do better. And at some point, we got to know the accelerator, the incubator, or a separate arm of Resolv Labs, which in fact helped us with the very first small investments, saying just keep the money, make at least the first version of the product, create a team, and develop it. Well, that's how it all started. Now, what's your team like? And if your business model is that you don't earn from this project, how do you support this project? Well, and here we smoothly move on to the topic of financing rounds. At the moment, our activity, well, at least what I remember, I'm just trying to recall if there are any exceptions or details, but it's probably right to say that all of it is investor money. For some time, this money will provide our living, but without taking into account any potential negative events that the market can become so bad or something else can happen that maybe we go bankrupt and lose TVL or production traction, generally we can earn much more than we spend now. You can, but you don't make any money yet, right? Yeah, that's right. Can we reveal the details that we discussed with you behind the scene? Can we reveal the details of the new round of financing that you're attracting? I probably wouldn't reveal it because it's coming to an end, but not all the documents have been signed as of yet. I expect that within a month, we will finish this procedure. But with whom have you signed already? We did. With whom, if it's not a secret? For now, I would wait for the signature from all the parties. Okay, so we can say that you're closing a new round now, right? Yeah. And you'll be releasing a new project with a separate token. In general, yeah, but these events are not really connected. Now we're closing a private round, if I'm not mistaken. First of all, to be sure that we have enough money for several years, even in the worst case scenarios, in terms of product traction, just to be able to sit and develop. Of course, in the ideal case, in the dream case scenario, I would say so that we, among other things, could have resources for very active development of partnerships, growth of the team, and so on. At the same time, as I said, our retail part is developing, and all sorts of incentive programs and standard points, crypto-related things in the last couple of years.
What's the structure of your team now, and what's the burn rate, if it's not a secret?
At the moment, we have 15 people on the team, if I'm not mistaken. There'll be 16 on Monday, and there are a few more people with whom we're actively communicating. I think our current plans are to hire about 20 people, and we'll have a couple of months to do so. A significant part of those 16 people are engineers. If I'm still considered an engineer, it's 1, 2, 3, 4, 5, 6, 7 or 8 people. We have a small team. It's a so-called trading team. It consists of people, first of all, who make sure that we have the right asset allocation. If somewhere, I don't know, it's a little bit more profitable to move assets for greater profitability with minimal risks, they do it. So they hedge the money of the new clients and process requests from clients who want to return the investment.
Do they do it manually, or do you have some kind of algorithm?
It's somewhere in between. We have a noticeable part automated, for example, to get client money and issue an asset and return, calculating the corresponding price, all that is done automatically. Hedging, for example, is now largely done manually, with some improvements and partial automation. We're also actively moving in this direction, developing our internal trading tools, co-offices, and more automation in this account. So, speaking of the team, what else to add here? There's a team that is responsible for the external relationship, headed by our CEO, as I mentioned. Formally and informally, there's also marketing. We try to communicate with the community. We try to be active in supporting more direct relations, including with retail users. We have a designer, a product team that deals with different things like coping with partners, communication with engineers in order to bring more details of such products and implement them. And I think I mentioned the largest part of the team. Maybe I forgot about 1 or 2 people, but that's mostly it.
What's the burn rate? Up to 60,000 or more?
More.
How's your technical infrastructure set up for now? How do you manage overflows? How do you calculate how profitable it is to overflow? And how do you react to some sudden movements? As I understand, your short position is open with leverage. If the Ethereum starts to grow rapidly, how do you react in this case?
As far as I understand, you're talking about the potential situation of margin calls and situations like that?
In general, how's your technical infrastructure built, and how do you deal with overflows? You said that most of it is manual. And how will you react if the Ethereum price starts to grow and you'll need to urgently raise the margin?
Well, first of all, I'd say it's the advantage of our team. The founders, core team, and others have a good experience of working with fiat in traditional finance, and they also have some experience of managing both money and risks. So, let's move on to the more direct question. Initially, we stick to the more conservative strategy, so as not to use huge leverage to keep the margin in control, simply because we already have several moving parts and we do not manage our own money. Therefore, by default, we hedge with a noticeably larger margin than necessary. Plus, we have an internal development which monitors the size of the asset and the size of the margin ratio, which we have at the moment. And when it falls below a certain level, first of all, it's reported to all the traders that something needs to be done. And in some places, we also begin to automate this process. That is, the human factor also slowly begins to be neutralized.
What lag do you have to switch between the flows? Do you do it instantly, or is there a specific lag?
Well, you can't trick physics. I'd put it this way. You get a signal. Some calculations on any trading movements are made. As I said before, we're not waiting until the last moment. We did the analysis and all that stuff, so we have a good reserve. And now I'm going to answer the question about lag. In most cases, we solve it in a matter of minutes. For example, it's either adding the margin from other accounts. For example, you can put staked Ethereum on some exchanges as collateral for certain operations. In some cases, it's necessary to reopen the position. That is, to close, for example, on this exchange and reopen on the other. And in this way, rebalancing, if, for example, the margin reserve on such an exchange was much larger.
How much do you spend on I understood that you earn about 2.7% of your base income from staking.
A few percent. But it's important to clarify that it's in Ethereum, because a lot of people think about dollars by default.
And this way, from 10 to 14% for holding short positions. And all of this can be summed up, for example, as 14 plus, let's put it this way, 12 plus 2 and 7, it's 14 and 7.
What you say from 10 to 14% is already summed up with funding rates and staking.
And from 10 to 14%, it's including staking, right?
Yeah, that's for the entire strategy that we use.
But do you think it's for 80% of the capital or for 100%? As you only hold 80% of the basic asset and 20% of them, 20 or 25 for sure, you hedge at the expense of short positions. And it's fair to consider this profitability not for the entire volume that you get, but for 80%.
You're trying to divide the income by specific sources.
I just want to understand, if we consider 2.7% plus is funding, it's up to 14%. But these 14% are for 80% of the capital. But if there's 100% of the capital, these 100% of the capital, respectively, is multiplied by 0.8. Probably they're 11% with something, right?
Indicatively, the logic of reasoning is that specific figures depend on the intervals and other things.
I'm interested in how much you spend on the maintenance of the strategy in terms of commissions, management of the strategy, overflows, opening and closing of the positions, and so on. Or is the profitability that you mentioned already includes these costs for the maintenance of the strategy?
I think it's right to say that it's mixed, because the payment for these fees and so on is made up of different components. Somewhere it's just a transaction fee, somewhere it's an exchange fee for opening and closing positions, somewhere it's for maintenance. In a different way, it either affects profitability and is deducted from the margin or some other collateral asset. Somewhere we sponsor companies. For example, for an on-chain transaction, we add for the gas fees to the executors who do all this. I probably won't mention the exact figures now, but it affects the profitability of customers. There are ways to optimize, including negotiations with exchanges for smaller fees, but I won't say that these are some super huge influencing factors.
How much are the expenses? 10% or 20%? Or maybe more?
I think it's something like 10%, maybe a little more depending on the period. We had periods when clients brought a lot of money, so you had to spend a lot of resources on hedging. This leads to the fact that the number of operations is increasing, and you actively get some kind of commission, let's say from the exchange or the counterparties with which you work. But at the same time, it often happens that for some volume, on the contrary, you get a discount. And depending on the balance of these parameters, this amount we pay can fluctuate a lot. And there are periods when the market is flat and there's flat traction on our part. Fortunately, this hasn't happened for a long time, but it has a different impact from this perspective.
How did you approach the choice of your jurisdiction, and where are you registered now?
Now we are a BVI company. If we talk about the current setup, we'll probably stop at this stage, but we're now actively starting to work with other jurisdictions. We start to work potentially more actively with licenses and other.
What are your plans for the future?
I don't think it's the right time to say it now, because there's a lot of work to be done, and I don't think it's worth talking about all that. I would say that we actively want to be legally compliant in as many countries as possible, because we see how our product can be useful for literally everyone. Of course, there's a number of countries where it's more difficult to comply with licenses, but we'll develop here as far as possible, or no matter how difficult it is.
Well, yeah, I agree. In fact, the issue of jurisdiction is very important, especially since there were cases, and we also carefully approach this. consciously, and we decided in favor of Singapore. We refused from offshores because we looked at the judicial practice and realized that often offshores have a more lenient regulator. And in Singapore, for example, there are more judicial cases. In fact, both investors and the company itself are better when there's such a guard, and you have no concerns whatsoever because the regulator will make the right decision or deal with this case.
Yeah, that's right. We understand it perfectly well. The balance is either to remain as unregulated as possible, of course, without breaking the law and so on. At the same time, this is what needs to be done sooner or later, because the crypto industry will be much more regulated in a short period of time. So it's better to start earlier than later, because it's going to take a lot of time and effort. So it should be done as soon as possible.
Yeah, I agree. How many users do you have now? Did you track those users, and what's the average check?
It's hard to tell by the number of users because the number is fluctuating, and the distribution by size, by specific asset, by specific network is also very diverse there. Super roughly speaking, indicatively, you need to double check. Probably the half comes from the retail. And by retail, I mean the secondary market, first of all. Maybe even much more. I haven't looked into the details for some time. A noticeable part comes from liquidity providers who either directly work with us or through some partners, but these are probably the main categories. Liquidity providers are people who professionally make money on liquidity provisioning, or whales or high net worth individuals, how they're usually called. There's also a category of arbiters who balance on the secondary markets with our assets.
As far as I understand, you don't have your own margin with LP and arbiters, do you?
No, we don't have it. We don't have a native mint at the moment, which is when you bring money, we create an emission, or vice versa when you want to withdraw. We don't take commission. But sometimes there are additional services that take a small commission, but some of them are designed to provide the right tools for arbiters, for them to burn faster, but at the same time to make sure they're not arbitrating our income mechanisms.
Let's talk about the assessment system. How do you assess the effectiveness of your strategy? What metrics allow you to assess these risks? What are the rates? And how objective is it to compare with the benchmark in terms of profitability from bonds?
That's a matter of perspective. It depends on priorities you have, what kind of user you are. Probably I'll start answering from the last question. If you compare it to bonds or to some other products, and in the context of the balance of risk-profit, and in the context of the instruments themselves, these are quite different products. And both make sense, to be honest. Depending on what assets you're targeting, depending on what risks you're ready to take, what is the profit? Well, as a user, I actively look at both, just from the point of view of diversification and risks and some other preferences. From the point of view of some metrics and so on, in terms of risks, obviously, and in terms of profitability, obviously, this is just the direct profitability of the whole pool. In this, we're quite transparent, and anyone can go and look at the chart, and specifically for each asset. There's a number of parameters that we're actively watching. It's, for example, the distribution on exchanges. Just from the point of view of diversification, this is the thing that I mentioned to you, that our goal is to come to the point where this layer of protection, RLP, always covers the potential exposure to at least one exchange, but ideally not one. We'll see how we get to this. And all sorts of things such as the margin ratio, what margin there is exactly, we're actively watching it. This is one of the things that we're actively monitoring at the moment. There are more long-term strategic things that we're looking at. This is the funding rates market as a whole, with a split, including venues. How do different assets perform? Well, in particular, we're mostly interested in Ethereum and how big its market is. But there are frequent questions, which can be obvious to some people. What if the funding rates are negative for a long time? What if something will happen to Ethereum? What if, on the contrary, you grow very well, but you'll end up in the Ethereum market or something like that? In particular, we're watching it really closely. We try not to miss anything. One of the obvious things that we can do, and in fact, we're already working on this is a small spoiler that I could say, is to use not only Ethereum as a collateral asset, but some other. Bitcoin is an obvious candidate. Bitcoin also has a very good market. Bitcoin as an ecosystem as DeFi is much less developed, but it's more than sustainable for our purposes. Funding rates and other sources of profitability have their own specifics, but we can use it to our advantage. This was also one of my questions about the expansion. As far as I understand, Bitcoin's profitability will be lower. Partially, yeah, but it's also an interesting point. The market or the volatility of funding rates, there are periods when the funding rate of Ethereum is noticeably lower than that of Bitcoin, and we can try to rebalance it using one or the other asset. Have you looked at the historical data on funding in 2022, when the market was falling? You mean Bitcoin and Ethereum, or in general? Yeah, Bitcoin and Ethereum. I can't tell you by memory. You can try to find illustrations, but they were simply negative for some time. For some time, they were much more positive. So we usually analyze such medium-long intervals, from a few months to a year. I don't think that this is a problem, at least for now, and I don't think this is a problem for us, considering that we're not engaged in any high-risk or high-active activities like high-frequency trading and so on. We have a pretty good backup, including in terms of time and the ability to diversify all this or to rebalance if necessary. How will you react if the financing rate is against you for a long time? For example, now I see that the financing rate is definitely against you. And how will you react if it continues to stay? What's the rate for now? Financing rate, probably, I don't remember either. Maybe minus 0.0, maybe 1/100th. But this is not holding for a long time. In general, historically, yeah, but if something happens and it's going to continue for a month, yeah, you're challenging me in the right way. It's purely in theory for now. And the more complicated thing is, though, we can turn the position around. The fact that the stake is negative means that the shortists now are paying to the longists. So we can try to turn the strategy around and be on the other side of this trade. In the current state, frankly speaking, it's not something you can do very easily, but we also keep that in mind. How do you define the way that you can do it? It's either using other instruments, other derivatives, or not specifically about this case, but using assets where the rate is different. That is, diversifying the assets themselves or the instruments that we use. If you compare, I can't say exactly for today and yesterday, the rate of funding of Ethereum and Bitcoin is different. And it's often positive for Bitcoin. The rate of Bitcoin is often more stable, more neutral, probably. Yeah, I think that's a good idea to talk about, considering what you said, and we agree with it. Bitcoin financing rate is often much lower than Ethereum's, but we can take more exposure to Bitcoin in the period of either volatility or negative rates. How do you feel about the recent FUD about the Ethereum ecosystem? The dynamics of its price, the change in the leadership of the Ethereum Foundation, and do you consider expanding to Solana? This is probably the main competitor of Ethereum, which is slowly eating up the share of Ethereum, especially on the meme market. Plus, on Solana, the profitability of liquid staking is much higher, and the funding rates are probably about the same. What do you think about that? I'll try to answer a few questions in order. The first one is about how we look at the Ethereum ecosystem in general, and the potential risk or excitement, or FUD as you called it. In short, it's fine. It's not the first time, both in relation to Ethereum and in relation to the crypto market as a whole, but of course we're following the situation, and there are things that can lead to some negative consequences, including negative consequences for the Ethereum market and so on. Well, the simplest one. The Ethereum market will greatly decrease in favor of some new or existing kinds like Ethereum. Solana is mentioned. One of the parts that we have been working on for a long time is asset diversification. So that at some point, if we need it, if this happens, we will significantly reduce the share of Ethereum. The share of Ethereum as a basic asset. the same time, we're still Ethereum-centric, so to speak. In the long term, we're bullish on Ethereum, but as I said, we're conservative people. We look at these risks with caution, so to speak. And it's important for us, for our clients, to be prepared for different outcomes. We'll try to change it if it's necessary. As for other instruments, networks, assets, I don't know what you meant, our product is divided into two parts. Our core strategy, core logic, asset management, and so on is on Ethereum now. We're working with centralized exchanges like Binance, Deribit, and Hyperliquid at the moment, and the choice of one of them is not so fundamental. Nevertheless, I don't think that in the near future we will actively move somewhere. We'll definitely look at the Solana ecosystem in this sense. Well, at some point we'll watch the situation. Maybe not at the horizon of the year, but depending on traction. The second part of our product is user tokens. Stablecoin is a more risky part, which we discussed before, and we're starting to distribute it on other networks. We started with Ethereum network, but you can find them not only on Ethereum network. At the moment, all these networks are VM networks, Ethereum-like networks, and Solana is an obvious potential next candidate. I don't know if it was recorded or not, but we probably discussed it behind the scenes. We're technically able to quickly and actively bridge our products to a lot of chains. At the same time, we don't want to do it the same way. We want to allocate targeted activity everywhere so that we could immediately develop the partnerships here and already have some activity, a user base, exactly on these chains. Solana is on the list. It's also in the plans.
Yeah, I understand. It's more about scaling the product in crypto. From the point of view of using the strategy, in my opinion, Solana, with its increased profitability on liquidity staking, could be interesting.
Yeah, you're totally right. And in general, if I was to make a top 3 assets, which from our point of view are sustainable for use, Solana is in this top 3.
Let's get back to the risks. Did you have audits?
Yeah.
What was found? How did this process happen?
In general, I honestly don't remember any super critical vulnerabilities that we found at the audit stage. First of all, I'm talking about the audit of smart contracts. We should talk about it in more detail. We are a hybrid. We're not a fully decentralized system. We have a lot of smart contracts, infrastructure, tokens, logic of interaction with users, execution of users' requests that are on-chain. At the same time, a noticeable part, including automation and some instruments, is the traditional backend of fintech. We audit both parts, but we have a special emphasis on the part of smart contracts, simply because smart contracts, especially in Ethereum, are the part that is visible to everyone. In most cases, you can look at the code and play with it, assimilate it, that is, it's easier to replicate, but the attacks are more dangerous or it's easier to spot. I'm probably relatively happy that at the moment I was able to build a rather strong technical team, in many ways thanks to my experience, in many ways thanks to the work of the team. I don't remember that we found any serious vulnerabilities. We actively invest in audits. Most of our code is approved by at least 2 auditors with the name, reputation, and so on. A significant part is approved even by 3 auditors. Yeah, and you know what? I think we'll continue in this direction.
What companies were there?
We started with Pessimistic and Mixbytes, then we joined Pashov because they have a slightly different logic of interaction and work with auditing. Some of them just are teams dedicated, they're training in-house, for example, on the domain, working with stablecoins or something like that. Some teams like Pashov recruit top competitors from different platforms like Sherlock or Quaterino. I think it's called something like that. Just by reputation, every time for each client, for each order, they recruit the top auditors. And often they can do it quickly if we need to audit something really quickly. While auditors with separate teams dedicated, they often have more stable expertise, and you begin to understand what to expect from them after some stage of work. They often have some kind of queue for audits, so we combine them. We also combined it with a competition platform, something like that, when some kind of open competitions of auditors are held.
Bug bounty, right?
Like bug bounty for a specific project, for a specific audit, it's probably the right way to say it.
Did you audit the on-chain part of the smart contracts or the internal part?
I didn't quite understand your question.
I mean, you have a server part, right?
You mean the off-chain part? Yeah, we have audited it, and we're having this pending audit with Hexen right now. They have the second iteration. The second wave is more complex, deeper, with different aspects to test this part. And it's important to understand that security is not limited to the code. Security is also distributed to the team, to the infrastructure, to the organization.
Social engineering?
Social engineering is what we also test, develop, and so on, through the practice of the team, through external auditors who help with training and so on.
How do you build security for assets? How do you distribute it among the team? Because if your team is delegated, remote, it's hard to track. This is probably a common problem in IT.
Well, first of all, most of the assets, especially non-chain assets, you're just not going to get access to them. And it works through multi-sig wallets and others. That is, one person simply cannot do anything for the majority or everyone at the moment. There's a significant point that we're actively developing now. We shouldn't have a place where a trader, for example, came to the Binance interface directly and do something there. We do it through our backend or additional services or purely through on-chain, depending on the direction.
Well, with custody thing, it's probably easier. You can connect API there. But with on-chain, this is the most important.
In order not to go into too much detail, because this is also a security thing, the less people know about it, the less our clients worry about it. And the thing that is public, in general, you can look at Chainway Treasury. It's a separate smart contract, audited several times, 3 times in particular. I guess it was audited, which firstly has restrictions on what types of operations with what assets it can have. That is conditionally even at the level of logic of a smart contract. For example, Ethereum. There was a complicated operation on the wallet that was not from the whitelist, and we whitelist those wallets as well. This is also not the operation that one person can do. And similar things. We can also limit the amounts that can be transferred, not just for trying to limit a hacker, which can potentially do something with evil intent, and among other things, reduce the human error factor on our part, or the bug factor in automated systems. We keep an eye on these factors.
I also thought about what I like about DeFi. It's transparency. You also have it. I like that in DeFi, you have the ability to monitor all on-chain assets in an online format. Even, for example, in DeFi credit protocols, you can monitor how your assets are placed, how they're used. Unlike banks, where the structure is not transparent and you do not understand how the bank uses your funds. In fact, the same risk of a bank run arises due to the fact that the bank may, well, it's always the case that the bank doesn't keep the liquidity that may be required at some point. And in DeFi, this is just the case. If liquidity is required, it will be returned, of course. The lack of liquidity in terms of asset value is a bit of a problem, of course, but in general, I like this transparency.
I'd like to add that I completely agree with you, and I believe that this is the aspect why our team has its strong points. We combine the strength of DeFi with TradeFi. DeFi is about what you just said, that the assets are transparent, we can manage them without additional intermediary services, and we're moving in this direction. That's why we have smart contracts and audits. We're developing this part. At the same time, we do not limit ourselves purely to DeFi, and we won't do it in the future. There are those crypto participants, but They are in between the worlds. I mean, centralized exchanges. For example, they work with crypto. It seems to be based on the methods of more traditional exchanges. We develop relations with them, including in the context of the product itself, such as managing and funding, and in the future too, depending on the development of the company in terms of some legal aspects. Not only legal aspects, we also want to work more closely with the TradeFi world.
What other risks can be there? How do you defend yourself from the scenario of black swans? In case of sudden growth of Ethereum, let's say 50% one candle pump, or well, we discussed hacking of exchanges. You have an insurance fund, and basically you can cover everything. But maybe you did some stress tests or modeling according to the Monte Carlo method, maybe something else?
The short answer is yes. We thought about it, did some modeling for sure. Speaking of the black swans, well, it depends. If you want a more specific answer, it depends on the more specific black swans. We've already discussed the scenario when the entire exchange flops. Part of the answer is that if suddenly the price of Ethereum rises sharply, but in general, everything is based on the management policy and the margin ratio that we discussed. But the best of this approach is that how we chose the base assets, starting with Ethereum, then Bitcoin, and Solana. In perspective, we do not opt for very volatile assets, including in order not to face the sharp fall or rise once or twice a day in a very short period of time. Fundamental factors are still not enough for this to happen because the market of Bitcoin and Ethereum is already too large for someone to be able to influence the market so much that the price will rise several times. But even with that in mind, the margin reserve is huge and there's nothing to worry about.
Well, it can grow by about 30% sharply. What's going to happen in this case?
The margin can handle 30%.
And if it's higher, what's going to happen then?
Sometimes it can handle even above 30%, and we can observe such fluctuations. As for modeling and other things, we did it. Many details we revealed in our blog, so you can check our blog where we publish such kind of materials, our analytics and modeling. The main feature of our product is that a large number of users are financially educated people who are interested in where all these risks come from, where the profitability comes from, and we're glad to explain and share this, despite the fact that not all these aspects are so simple to explain.
What other risks there are? Maybe the price divergences between spot and futures?
One of the tasks that we work on is to reduce these risks or this discrepancy. In fact, a popular trading task is when you perform several operations and your task is to make them as close to each other as possible in terms of price, time, or other characteristics. To be honest, there are risks, but they're not so significant that users can feel any impact at all. So when the client's money comes, we have to hedge them. That is, open a long, open a short, well, with everything we discussed. These are two operations, they're usually independent due to the setup. In practice, this means that they're independent, including in the price of each other. There may be such a situation when we, for example, we open a long position on Ethereum at one price, then we opened a short position at a slightly different price because of a certain fluctuation.
Well, or at one price there was a discrepancy and you're already a victim of circumstances.
Well, accordingly, we can either lose here or earn, depending on whether we're lucky or not, or some other factors. For some reason, this is not a very significant case for us, probably. At the moment, clients bring us other stables, well, USDT and USDC in particular. In concrete example, we don't have to rush to hedge them. It's a conscious policy. If the market behaves inadequately, it can mean that the funding rates are negative. We can just keep some of the assets in the stablecoins. By the way, this is part of the answer to the question of how we can level long periods of negative funding rates. One of the ways, if we can't expect a positive return for a long time, it's to use other stablecoins or other instruments that do not pose such risks, specifically about the price discrepancy of two operations. We do not immediately get them back if a client, for example, brought 10 million. We do not do it in one go, but with several batches, even if we are somewhere in the normal market. For now, let's discuss this case. So the average of these operations is almost zero. Even if there's some discrepancy, we can fix it with small batches. And afterwards, it's a tiny impact for the whole strategy. Have you looked at the historical data? How often such discrepancies happened and for what reason? As a result of trades? Not because of trades, but let's say that you have a position, 500 million or 400 million long spot, let's say on Ethereum, and for the remaining amount, for 100, 200 million, you open a short. And it so happened that the spot price parted with the futures price. And I think this is the main risk, where you can fall into the trap of not being able to rebalance at the right price. And accordingly, if in addition to this, you can wait, of course, if this is a temporary event. But if you add this to this situation that Ethereum grow and you're going to be margining, you'll not be able to rebalance at a good price. And this can be a problem here. Have you looked at the historical data of the past few years? How often there have been such discrepancies and for what reasons? You mean the difference between the spot price and the perpetual future opening price in our case? Yeah, they happen. Again, how big they are, it's difficult for me to say at the moment. They're not so significant that it would affect us in a significant way in the long term. But the answer is actually very similar to what we do. That if the market is volatile, we'll just keep some part in the stablecoins. That's it. There's no need for us to do many operations a day. It's not a high-frequency trading. We are risk-averse people, so to speak. Yeah, I got it. When you're in a position, you can't do anything here. When we are in a position, we just keep it. But if Ethereum market goes up so much, for example, then we add the margin. As a rule, we already have a staked Ethereum. We do not need to change Ethereum into something else. That is, speaking of the risk of changing the price, if it's there, it's definitely in other aspects. Or vice versa. The price is falling, the short is growing very much, and at some point we need to fix it, just to have less exposure in the exchange. But this is a separate trading task. As far as I saw, you have about 20% of the assets in stablecoins, just to provide margin for perpetual futures. Yes and no, depending on the period of time you're looking at. Maybe just client assets that were brought to us a short time ago, which we haven't yet managed to hedge. The second part of these stables, we use a collateral asset on some exchanges. Some exchanges want Ethereum as a collateral asset, and this is generally great because we can immediately use the longed Ethereum. Some allow even staked Ethereum, in other words, the profitability is optimized with minimal risks, and some of them want stablecoins, and the part of these stablecoins that you see is a collateral asset, a margin for shorts. Yeah, and here, it also turns out that there's a risk that the stablecoin that you're holding may be depegged, and what's going to happen in this case? We keep minimum exposure in stablecoins. At the moment, we do not consider the option of using a large number of stablecoins. We use two the most reliable ones, two the most popular stablecoins. The policy is similar to the one I told you about the use of a base asset in the form of Ethereum and Solana, potentially in the future. We need the most stable and reliable instruments that we use as a main part of the strategy. Here, I would also like to note that, as I remember, you use custodians, which give you access to exchanges. Another element of security that can be used is the technologies that custody provides. They give access to trading on exchanges without the risk of a full-fledged transfer of your assets' collateral value to the exchange itself. So, do you use it? And it's also kind of protection mechanism. We said that even if the exchange collapsed, as it was the case with FTX, such custody storages that give access to trading on exchanges could really save the day. Correct. Thank you for reminding me. This is a very significant aspect of how we potentially level some risks. That is the super negative scenario that we discussed, that one of the exchange crashes. This doesn't mean that we would immediately lose everything that was connected with this exchange, like margin for shorts, for perpetual futures, and other assets. We deliberately develop relations with custodians in order to keep the maximum of such funds not directly on the exchange, but on the custodians through whom we make these trades. Many of the custodians with whom we're now developing relations and exchanges, and many of those with whom we're potentially going to develop relations, allow us to delegate the money that's in the custody accounts for the trades made in the exchange in accordance with the partnerships that they have on the exchanges. So, from the point of view of interaction with the exchange, we could do all this and nothing would change for us in terms of asset management, and at the same time, the assets are not on the exchange. There are also possible options depending on what kind of exchange can potentially crash. Of course, there may be, let's say, some malicious intentions from the exchange, or, I don't know, when interacting with the custodian, so that they deliberately transfer part of the assets to themselves or open certain operations. But this can happen only if people start to steal the client's money deliberately. If you consider the case of FTX or some other hacks, this usually doesn't happen. The chances that we and our clients will remain with our assets greatly increase.
Yeah, this is a good technology. We also use it to ensure these risks.
That's interesting. How did you come to this?
Well, let's say custodians allow you to manage accounts without using funds. They allow you to distribute roles among the team. Someone can manage, someone is responsible for transactions, and so on. Here, you can also set up a transparent work with investors. The assets are also clearly visible and are owned by the client. And you have the opportunity to be able to control these assets. Well, transparency, as I said, and an insurance from the collapse of the exchange. Some custodians, Fireblocks, Copper, give the opportunity to use this technology. And the only risk I see is this is unrealized P&L that can be accumulated there. But custodian assures that this unrealized P&L is also taken into account in their relations with the exchange. So, I don't know how reliable it is.
Well, in practice, as far as I've dived into the topic, it also depends on the specific combination of a custodian and an exchange. This is not always the case, and to some extent, this is why we need to settle P&L, even though we don't have the financial need to do so. I mentioned it briefly, but in regards to custodians, it probably becomes a little more clear.
Yeah, I agree. When we were chatting, you said that there's a common question. Why don't I just invest in US Treasuries? How do you answer that?
The approximate essence of the answer consists of several aspects. The first is the balance of risk and profitability, which I mentioned to you. Well, one does not contradict the other, it's just simple. If it's easier and more clear for you, go ahead and choose US Treasuries. Well, it's up to you. We offer something different. If we talk about opportunities, about how you want to use it, how liquid it is, and so on, maybe not only financial aspect, but our products can be much more interesting. That's why we were able to get the first traction from crypto-native people or more crypto-friendly people who seem to know about treasuries, but for various reasons, it doesn't suit them. Either simply because they don't have money in fiat, or treasury is not suitable for them, or they simply use our instruments on secondary markets as a base asset, as a foundation for other instruments.
Are they professional participants or crypto-native guys? Because in my experience, crypto-native guys are not satisfied with 10, 15, 20% profitability. They usually want to go all in on futures and waste all the money without realizing that this is not a long-term strategy and they can only earn in a moment.
You're totally right, and I have a funny story that I periodically recall and tell everyone. About a year ago, when we launched the first super closed alpha version, so we just started testing just to check that we do not have any technical, economic issues, that this whole thing is not falling apart. We decided to ask our friends if they wanted to try it out. There was an outstanding case when one person said that, I'm not interested in any strategies or products that give less than 1% per day. Oh, that was hilarious. I said it's up to you, but that's just not our audience. And for example, if you take TradeFi comprehensive people, If you tell them about 10-15%, they'll be really amazed to know that the risks here are not high at all. One of our significant target audience is crypto or financially comprehensive people. If they're not the professionals, but those people who understand the market, they understand how the economy works, but they also understand what opportunities can be there. In this regard, I agree with you. Yeah, DeFi currently gives competitive advantages, competitive profitability. I see a pattern for myself that the subsequent reduction in rates will lead to the liberation of liquidity that can be directed to DeFi, which will possibly contribute to the release of new stablecoins and the growth of the DeFi market as a whole. And if we talk about our Eastern European audience, CIS audience, I think that DeFi is really competitive compared to US Treasuries. First of all, because we're in the cycle of rate cuts. More than half of the central banks are already planning to lower their rates. This year, we expect more than 2 rate cuts. Secondly, for the CIS audience, it seems to me that now is a perfect time. During the Russian ruble strengthening, in addition to obtaining 10, 15, 20% profitability, double-digit profitability in DeFi, to earn even a potential devaluation of the currency with a fairly high mathematical expectation. And in general, here, of course, I do not take into account the infrastructural risks. Unlike the US Treasuries or the long-term markets of some foreign banks, where just because you have a red passport, your assets can be blocked like anytime. And speaking of DeFi, there's a chance that things like that will never happen.
Yeah, I agree. As I said, we're somewhere at the crossroads of these worlds, and most likely we will be. In particular, I hope that we will be able to apply the best from both spheres, not the worst. But time will tell. Final question. What advice would you give to entrepreneurs who want to implement their projects in crypto or fintech and traditional finance? On the one hand, I want to say the common thing. Just don't be afraid to try new things. On the other hand, if we clarify and let's say in fintech and crypto, especially if you work with someone's money or if you work with your own money but you're not ready to risk them, but I think it's worth gaining some experience in this field or to find complementary people. If we're talking about entrepreneurship, I would advise to try to answer the question, what is your role, direction of your idea, what are your strengths, and what are your weaknesses? Do you have the potential to find such opportunities? Do you want or are you ready to completely cover it all? If not, what skills in other people and partners can be useful for you? And we just look for such people. Regardless of how you answer these questions, in terms of, I don't know, creating a team or from one person or several, such similar questions will have to be asked when you create a core team. Short blitz. Bitcoin or Ethereum? Ethereum, of course, in the context of the whole conversation. Ethereum or a stablecoin? Both stablecoin and Ethereum. I'm a risk-averse person. I don't keep everything in one place. Centralization or decentralization? In general, it's probably decentralization, but often it can mean different aspects of the category, such as more regulation or less regulation, and things like that. I believe that the centralized part can adapt well, including traditional finance and others that are more regulated, but decentralization perhaps will not be decentralized in the full sense. It's going to be in the form of a hybrid. I agree. Spot or futures? Obviously, in the context of our conversation, both of them, spot and futures. 80-20. Bitcoin at $200,000 this year or not? Honestly, it's not that important to me. Well, rather yeah, but more in a pragmatic perspective to wish Bitcoin at $200,000, most likely to wish that the entire crypto market or a significant part of it will go up, not go down. And accordingly, this is more likely to be rather good for our product. But in general, I can't say that I really want Bitcoin to be 200,000. That's it. Thank you for your time. I wish your project to reach the $1 billion level and develop further. Thank you very much. I also wish our project to grow and develop.
And thank you for having me. I also hope to see many interesting people in the future.
Thank you guys for watching. Stay with us. Bye bye.